Like, you
I
can
think
just
that'd be
sit and
worse.
stay, and then as soon as you back up, it like follows you and like sits down. And like, wait, like, where are you going?
Hey, Katie, can you start me a sign-in sheet? Thanks.
You don't care for the Wonder Years? Really? And not their music, but I said they're great live.
I'm not a big fan of
I can't comment on my stuff. No, it was like meant to be positive.
Like, even though I don't
I
like
just try to
them,
comment every
they're
Wednesday.
still really
No,
great.
it was me. She doesn't like a Wonder Year.
All right, guys, so I'm thrilled that the number of you who actually came back. I consider that a good sign. Not a testament to my talent as a teacher, but your determination to actually wade through this. So with that being said, I realized that one of my shortcomings, well, I've always known this, is actually doing impromptu math on a dry board. So I feel like I threw a lot of numbers at you guys last week, and I am going to re-throw a couple of them at you right now, but hopefully in a way that will actually make a little more sense. No, it's a little more structured, and you'll follow it. Don't worry, you'll follow it. And things ended up working out more the way that they were last week when we were talking about the difference in an LLC and an S Corp, and I ended up doing the $30,000 income, and it still was cheaper to be. I mean, you're still saving money being an S Corp. I knew there was something wrong, so I actually went through and did reworked it all. So that's really weird. Oh, that's because this projector is way too bright. Oh, anyway. There's actually shadings in here, and there's lines that go through all of this, but they're all gone. So ignore this whole part over here. Forget this whole part over here, and just focus on this part right here. So what this part is that it's in this column is making money as a LLC, and in this column doing it as an S Corp, and making exactly the same money. Okay, we good on that one? So in an LLC situation, your income is $100,000. You have to pay yourself all of that money. It's considered to be either your salary or your wage, and that's all taxable. Make sense? And in that income bracket, in this income bracket of about $30,000, I mean $100,000, out of that you pay FICA. What FICA is, half of it's not exactly half and half, but part of it is Medicare and part of it is Social Security. So this is money that eventually you're going to get back. You will get it back when you turn 65 and you start collecting Social Security. And when you also turn 65, you don't have to have health insurance anymore because you can go into the Medicare program. So this is to pay for all of that. You pay, it doesn't matter who this happens to you, no matter where you work, blah, 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 blah. It's the government's way of making sure that they're going to take care of you when you get older. Income tax is on top of that. And in a $100,000 income, you are roughly in a 33% income tax bracket in this LLC. So the FICA was is 15.3%, that net $15,300. Your income tax was $33,000 because that's the income tax you're bracketed in. You subtract both of these taxes from your $100,000 income, and your take home is $51,700. Does that make sense, everybody? It's relatively straight and simple and stuff. Straightforward and simple, right? However, in an S Corp, you can play games, and that's what S Corp is all about. Both of these, again, an LLC will still protect you as far as liability goes, either physical or financial. Same thing here in an S Corp. But in S Corp, we change things around, and basically it's what you're really doing in an S Corp is you're designating money as something other than salary. You still get it, but you're designating it something other than salary. So in an S Corp, you're making the same $100,000. However, you pay yourself only $6,000. That's your salary for the year. Now, I know that may sound absurd, but it's what everybody does. So at any rate, the same thing holds true. You still have to pay FICA on this $6,000, which is $918, and you still have to pay income tax. But the income tax rate on $6,000 is only 15%. It's not going to be 30% or 33%. It's $6,000. The less money you make, the lower your tax rate is. The more money you make, the higher your tax rate is. So in this case right here, the income tax that's due on this $6,000 is $900. However, the one thing that we do have in S Corps that we didn't have in here is the stuff that you need to actually have an S corporation. You need legal and accounting fees. You might try to do the accounting yourself, but you're going to need the legal part. not just to set it up, but to actually maintain it. They do all sorts of things every year, stuff that has to be filed with the state, minutes of your annual meetings, blah, 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 all this. Anyway, it ends up coming about, I looked up mine, it's about $8,000. So if you take this $100,000 and you subtract the $6,000 in salary and the $918 in FICA and the $900 in tax and the $8,000 in accounting, you end up with $84,182 left over. That's what is left. You take that money out as a stock dividend. You are one of the owners of the company. You take it out as a stock dividend. And the reason you do this is because the highest rate on stock dividends is 15%. Actually, it's the only rate on stock dividends. Does that make sense? So instead of being taxed at this 33% up here, I'm actually taxed at 15% on all of my income. All $100,000 is actually taxed at that same 15%. Does that make sense? I actually pick up a little more savings than the FICA thing right here. Nonetheless, so the dividend tax on that's going to be $12,627. My net is an S corp. My net income now is $67,737, and the difference in being an S corporation over a LLC is I get to pocket an extra $16,000. Does that make sense? So that's the game, right? So let's then go to the other extreme, all the way over here. It's the very same thing, except over here we only make $30,000. So I'm going to do the exact same trick. The whole $30,000 in the LLC comes down. It is considered the salaries and wages. The FICA on this would be $45,900. The income tax on this, again, the income tax now down here is only 15% because, again, we're in this 30,000 range. We're not up in that 100,000 range. We're a little bit less down here, so roughly that. Again, no accounting fees, no dividends, no dividend tax income. So the net income out of this, if you subtract both of these taxes from the $30,000, you end up with $20,910. Make sense? In the S corporation, though, we do the exact same trick. Again, it's $30,000. We only do $6,000 in salary. The FICA and the income tax are identical. However, I've still got $8,000 in accounting fees. What the money that's left over is now $14,182. Again, I pay the dividend tax on that, the 15% dividend tax. However, my net take home into this guy is now only $8,237. You can see if you had been an LLC, you would have made $12,673 more than an S corporation. Does that make sense? Are there any questions about this? So somewhere you can see the $100,000 you're better off doing the S corp, the $30,000 you're better off doing the LLC. Somewhere in the middle, it balances out and it doesn't really matter. At one point, it ends up evening up, and because I had a spreadsheet, I could actually generate that. At $68,235 in income, it doesn't matter which you are. You end up with the same amount of money at the end of the day. Make sense? So it's worth noting that this is simplified. I've made assumptions here. So for instance, I've made assumptions that in this, your tax bracket in here would only be 25%. That may not exactly be true. That it could be 23%, but these numbers are close. They generate, my accounting fees and legal fees might be $7,000, might be $10,000. I mean, this is not exact. Do not go home or go out of here thinking that, wow, $68,235 is the break-even point. It's going to be close to that. It's what I told you guys last week. It's right around that $60,000, $70,000 mark. At that point, anything less than that, you're better off LLC. Anything more than that, you're better S corp. Make sense? And the more money you make, the better. The more money that you make out here, when this goes to $150,000, this starts to really climb. So the more money you make, it's still the better off you are being an S corp. Are there questions about this? Okay, so that was one thing that I thought was a little bit confusing. Hopefully that clears stuff up a little bit. The next thing was the whole expense thing. So, and the percentages of expenses. So in this case, the income, again, is $100,000. We're going to look at two different people here. We're going to look at this first column right here as somebody who has no expenses at all. We're going to look at the second column over here as somebody who actually has $10,000 in expense. Okay, so we'll go through the first one first. So the income is $100,000. The expenses, and guys, the only reason I picked $100,000 is it makes the math easy. So I realize that you guys might not be making $100,000 your first year out, but hopefully you will. So the expenses are zero. So the taxable income becomes $100,000. There were no expenses. You made $100,000. You got to pay tax on the whole $100,000, right? So in a 25% tax bracket, and I only picked 25% here, it actually would be more, but it keeps the math simple so that you guys can see it. When I started getting into the 37.6% tax rate, it just started generating these very strange numbers. So again, this is for illustration purposes only. Does that make sense? Okay, so I just picked this 25% tax rate. So the tax would be $25,000. And if you look at this line down here, so the net income, what you end up taking home after all the taxes are paid, is $75,000. Does that make sense? We're good on that? Okay, so in this case over here, same scenario, $100,000, but in this case, there's a $10,000 expense. That expense is subtracted from this income, and it gives you a taxable income of $90,000, right? The $10,000 expense is gone. It reduces your income by $10,000. And again, this is a business expense. This is a deductible expense. So again, in your all's case, this would be renting a studio. This would be processing film. This would be paying a model, paying hair and makeup. This is not your rent, right? Rent's not a deductible expense. If you pay for a studio, that is. The rent on the studio would be a deductible expense, but the rent at your house is not deductible to you guys, right? Again, it's got to be related to your business. That's the expenses that, so you've got non-deductible expenses and you've got deductible expenses, right? It's got to be related to your business in order to deduct it. Now, also what I told you guys last week is that there's a huge number of things in your life that you can claim to be a business expense that are your quality of life, that are the things that you do in your life. So for instance, your cable bill, right? You go home and watch TV. I call that a business expense. You are actually studying to further your visual culture, your understanding of what you consider to be contemporary in terms of any visual culture, fashion, on and on and on. Yeah, I watch Project One Way because I'm a fashion photographer. Who's going to argue against that? Right? So at any rate, the $10,000 comes off. So again, it's still in a 25% tax bracket. So 25% of this $90,000 is $22,500. If you subtract the tax that the person with no expenses had, if you subtract the one that the person did have expenses from that, you get this guy right here. This $25,000 is the person who had no expenses. This $22,500, we're going to subtract it, and you can see that the tax bill, the difference in these two tax bills is $2,500, right? So it's not that you can take this $10,000 expense off the tax bill. It's not that this gets knocked off of $25,000 and you have a $15,000 tax bill. It's this comes out of your income and it reduces your tax by this $2,500. Well, if you look at the expense that we were claiming, this $10,000 right here, and you multiply it times the tax rate, that is actually your tax savings right here. These two figures are exactly the same. That's what I was trying to get across to you guys before. Whatever your expense is, the government will pick up whatever your tax rate is of that expense. So if you have a $10,000 expense and you're in a 33% bracket, the government will you will reduce your tax bill by $3,300, which is 33% of $10,000. If you're in a 15% tax bracket, and again, it's a $10,000 expense, the government will reduce your tax burden by $1,500, which is 15% of your expense. Does that make sense? However, in the end, you got this expense is gone and the tax bill has been reduced, but at the end, the person with no expenses is still making more money. Even though you've reduced your tax rate by having an expense, you had to pay for the expense. That money's gone. You didn't make that money. So in the end, the person who doesn't have any expenses is actually making more money, even though their tax bill is actually higher. So what I'm trying to say is that if you think a good tax strategy would be to run up your expenses as high as you possibly can afford, that would probably not be good advice. Or the flip side on this, my wife gets into this all the time. She gets really angry when we start to look at our estimated tax payments. Really angry. And we can actually reduce our income And my lawyer said this to me a long time ago, and I'm going to say it to you guys right now, and you should implant deeply in your brain. The worst tax strategy in the world to save taxes is to not make money. Because if you take that conclusion that to its logical conclusion, if you make absolutely no money, you won't pay any tax. If you lose money, you won't pay any tax. But then you have no money. Okay, are there questions about this? Make sense? All right. So I'm going to show you what I think you guys should be considering doing. I created a mock account. This is just a mock bank account. Quicken is the program that I use to do my to track my accounting. Quicken 2007 is the last version of Quicken that anybody really is considering. Well, Quicken has had a love-hate relationship with Macintosh forever. If you work in a Windows world, Quicken is actually the state-of-the-art for Windows. Pretty much anybody who's using Windows PC, that's the accounting situation they use. There's two versions of it. There's Quicken and then there's QuickBooks. Those are two different types of accounting programs. And so we need to talk about the difference and what the difference is and why. There are two types of accounting that exist in the world. There's cash accounting and there's accrual accounting. And what happens in cash accounting, and it's the system that it's the one that I use myself. I've always used it. I use it to this day. It's the one that I'm going to actually suggest you guys do, but there's issues about it. So I'll tell you what those are in just a second. Can you guys see this all the way over here? There. I'll just do it over here. Can you guys see? FA16 I think. You guys know that, well, if you don't know, I'm awful, god-awful speller. So, we're going to do, what's today's date? 17th. Okay, so 10/17. Can you guys see this? No, Bailey, you can't see this, right? Can you see that? Yeah, okay. So we're going to shoot the job on the 17th, and it's you guys all see that? All right. So we're going to shoot the job. That means I can actually stretch this out, which I need to do. So So 10/17, we shoot the job. And the job, and so we're going to get paid, we'll stay with $10,000. Also on 10/17, I have to spend $2,000 in hair and makeup. So yeah, does that make sense?
Are you billing that to your client in addition to the $10,000, or does that come out of your?
It doesn't matter right now. For illustration purposes, this isn't going to matter. Yes, that does get billed to my client, and yes, I would actually get paid that money back. But so actually say that. So what I'm really due is $12,000. Does that whole illustration make sense to you guys, right? So in accrual accounting, what happens is this. On the 17th, I made $10,000. And I spent, so this is income. And I also on 10/17, I had a $2,000 expense. And this is just considered, this is when it all happens. This has got nothing to do when my client pays me. It's nothing to do with that at all. So if my client, say my client pays me in a month, that's fine. It doesn't, nothing in this part actually ever changes. I don't enter anything else into my books. No, it's just because I've already declared the income and the expense on the day that they actually happen. Does that make sense? If the client never pays me, this is considered a bad debt, and at the end of the year, this is removed. So at the end of the year, so if I get paid, you never see anything else, your books are fine. If you never get paid, if they stiff you, you'll end up with, at the end of the year, we'll say 12/31, with a bad debt, and you actually subtract from your income, you would actually pull this part out, because this is money that you have not made. So you would minus the $10,000, and you still have eaten. If you've actually paid for this expense, you actually lose that too. So you basically lose, you're losing the $12,000, the whole thing. Does that make sense, what's going on here? So this is what happens in accrual accounting. And in cash accounting, it works completely different. In cash accounting, you typically manage it out of a checking account. The first thing that I can say to you guys is that when you do decide you are going to go into business, the first thing you do after you go ahead and decide, file to establish your LLC, and also file to get your sales tax certificate. The next thing that you need to consider doing is that you need to consider setting up a separate bank account that is strictly your business. You do not want to mix your personal bank account with your business. It's so funny. Oh, okay. Okay. You could also consider, if you're going to do credit cards, to actually do a credit card only in the name of the corporation as well. Some people don't go quite that far, but your bank account should definitely be separate, because your bank account is the way, your bank account will actually become your books, which is the beautiful thing about it. So what happens in a cash accounting here is that you don't see any of this action until you either, the check is deposited and it clears, or you write a check and that check is withdrawn from your bank. So you bill the client, you shot the job on the 17th, you bill your client, but your client doesn't pay you for 60 days, which is common. 30 days, you're lucky if you're getting it paid. 60 is pretty common. 90 is what some people pay. There's even people who pay out at 120 days. Basically, you're loaning them money for 120 days. So in this case, let's say the client pays in 60 days. So for me, instead of this money happening on the 17th, it's 60 days later, which would be the 12th. I'm sorry, the 17th of December is when I have my $10,000 income. And it's when the check clears. So if I never get paid, this doesn't exist. This entry never happens. If they never pay me, I never made the money. The only time I actually make the money is when the check actually clears and that money is in my bank account. That's when I am considered to have made that money. Make sense? The expense, so let's say again, the hair and makeup artist bills me for this, or actually this is going to be $12,000 because my client's going to pay me for the expense as well. But let's say the hair and makeup person has billed me for this $2,000, and let's say I'm really good and I pay her only 30 days out. So I'm going to pay her on the 17th of November. So this is my $2,000 in expenses. And when this check clears my bank account is when I incur the expense. It doesn't have anything to do with when we shop. It only has to do with I wrote her a $2,000 check, I mailed it to her, she put it into her bank account, they take the money out of my account. On the day that they remove the money from my account is the day I incur that expense. If she never cashes the check, I never have the expense. Does that make sense? So what you end up happening here in this situation, you'll see a number of things happen. The first one, and the biggest problem with this, is that this does not give you any indication of when you are busy. When you're claiming your income is not when you're shooting it. You're claiming your income 2 months after you've actually shot the job. And so imagine this, blow this out over the course of a year and 100 jobs, you have no clue about when you're really shooting, when you're busy. Some clients are paying 60 days, some 120, some pay 30. There's no way for you to be able to track your business, to know when was I busy? Was I busy in October? Was I busy in January? You have no way of knowing. In accrual accounting, you know to the day when it happened, because you're claiming the money on the day you actually created the income, the day you actually shot. Does that make sense? So, hang on one second. So big companies only do this kind of accounting because they need to know, they need to be able to forecast when they're actually going to make money, when they're not going to make money. Because all of this, imagine if you're, GE and you're having to buy stuff to build airplanes or whatever, you need to know when your busy season is to build these things, when you're going to need to get inventory to do it, when you need to hire on more people. All of those decisions need to be made if you've got a really clear snapshot of your business. However, in our case, this is far more complex accounting, far more managing all of this. But again, it's a more accurate reflection of when you were really doing the work. This, on the other hand, is how most people do it. But there's another problem in this. What's the problem that you see in this? Well, let's say I had $100,000 to begin with. So I'm not going to actually worry about that in both accounts. So this is my beginning balance. That's not the problem. What's the problem right here? I'm paying the expense out before I make the money. If you do this too much, you will go broke. This is what they call cash flow. This is when they refer to cash flow. It's this situation right here, and it's the whole idea that you can't be spending money on things that you haven't made the money for. If you do that too much, you end up making absolutely no money. Now, eventually, you will get that money, but what happens, you got to carry this for a while. So I'm paying my hair and makeup person in November. I don't get paid back for that until December. That means I have loaned this money to the company that's paying me. I've made a loan to them of $2,000 for 30 days, and I haven't collected a dime for it. Does that make sense? Yes, she does not get paid until I get paid. That is not a cash flow problem. Make sense? So it's something that you guys need to seriously think about in terms of doing this. So Alex, you have a question?
Yeah. Why do companies not pay you within that week?
Because they're sitting on that cash and they're making money on it. True story. I've only been in one car accident in my life, knock on wood. And a guy was drunk. I was driving up Damon Avenue, a guy in the snow, a guy was drunk with a baby in the back of his car in no car seat. Cut in front of me, I hit him, he pushed me into another lane, another car hit me. The police show up. It's clearly, he is so fucking high. It's clear to that. They cite him, they arrest him, they take the baby, the whole 9 yards, right? He's got, what's the insurance company that they sing the song about? No, United Auto Insurance, 773. Okay, that's his insurance company. That was his insurance company. They refused to pay. They refused to settle on this, and they have a team of lawyers that work for the company. And the lawyers took it to court and said, "No, this is not true. We're fighting this the whole thing, the whole way." At the time, I was living in Italy. I had been back here for the holidays, so I'm in Italy. I have to be deposed in Italy before Skype existed, right? So I'm on the phone, I'm sending stuff, so going back and forth with the lawyers, whatever. They carry this thing out for 3 years. They take it to court. They start to seat the jury. They drag out the jury selection for almost 2 weeks. They get 11 of the 12 jurors seated and settled. Why? Well, they were out $40,000, but they'd sat on that $40,000 for over 3 years. How much money do you think they made on their $30,000 over 3 years? If they only made 10%, they made 10% of $30,000, $3 grand a year. They made $9,000 just sitting on that money, just dragging it out. $9,000 is what they saved on that. So instead of really being hit with a $30,000 hit, they got hit with a 21 because they made that money. Does that make sense? So the reason they don't pay you is they're holding on their money. Not only are they making money on their money, but this whole cash flow issue becomes less of a burden for them. Are there questions about this? So to be able to do this, so again, this is how I'm going to suggest you guys actually operate your business. And what that means is when the check comes in and the check clears, you make the money. When the expense goes out, when you write a check and that check actually clears, that's when you incur the expense. And you can do that really easily simply by doing it with a checkbook. So that's what I've got right here. I started out as a completely blank checkbook. There's nothing in there. I've got a starting balance in here of $10,000. I put $10,000 of my own money into my bank account to open it and started my company. So I do a job, and I do a job for, well, let's say, just like today, I did a job for Shock. And this wouldn't happen actually on the 17th now because they're not going to pay me today. So let's say they pay me in a month. So I am going to go up to my little calendar part, little guy right here, and it would be 2016, and this would be a deposit, and I would put in Shock. And we'll use these same figures that we were actually using right here. This will actually be a perfect illustration that we've got going right here. So I'm going to deposit $12,000. Now again, this has nothing to do. This has got nothing to do with when I did the job. I did the job today. I could have done it 6 months ago, and they finally paid me. It doesn't matter. When this becomes an income for me is when this deposit is actually made. I would put in the job number, and the job numbers that I use are this. CH161017, that's the job number. Oh, I take it back. That's actually the account. Sorry. In this drop-down menu, you have a whole series of categories. These are actually established for us when you actually create this bank account. I've already given you this list. This is a really good exhaustive list. This is not complete because I didn't want to spend the time filling all of these in. But the list that I gave you that you would use, that you should consider at least for yours, would actually be in here. So these are income and expenses that have been combined. So for instance, photo expenses is an income. I'll tell you what that actually means right there. Studio rental here, all these kind of things, this would all be. So in my case right now, I'm actually going to split this open. And in my first category right here, I'm going to have photo fees. And it was $10,000. Ooh, I made $120,000 with those guys. That was a really good job. You know, there was a day in my life, never mind. I'm not going to go down that road. Okay. So I come over, it was $10,000 was my photo fee. I'm just into that $100,000 figure, right? Then photo expenses, get away from this. Is it telling me something? Oh, come on. Okay, 1, 0, and then there's 2 more zeros, right? Then it's 1,000. You can see why apparently I'm not really good on the math board. Okay, so in here, then the next one would be photo expenses. So photo expenses is an income, and the reason I do it this way is that I want to be able to track the difference between this hair. This is a hair and makeup expense for me. That's what it's going to be. I never made that money. I'm paid that money, but I'm going to have to turn right around and kick that money right back out to the hair and makeup artist, right? So if I was doing a markup on this, then I would be making money on it. So let's say the hair and makeup person was charging me $2,000 and I billed the client $3,000. Then I would actually make $1,000 on that deal. That would be my markup. Does that make sense? But what I'm really concerned about, more importantly, in this whole game right here, is tracking this $10,000. That's my photo fee. That gives me an idea of what I actually made, not the rest of this stuff. Does that make sense? There was a photographer here in town, Peter Rosenbaum, who actually he shot for Spiegel. He grabbed Spiegel as an account and shot for them for 3 or 4 years. He also did all the production for his photo shootings, right? And they were using only the top talent out of New York. I mean, they were using the really big girls. They were using the really famous, the Cindy's, and they were using all of those guys, right? His billings for his photo fees were about $1.5 million in 1 year. His billing for his production company was $20 million. Out of that, he probably made 5. So marking up is a great thing, but again, it perverts the figures. It doesn't give you a good sense of how you actually are really doing as a photographer, right? So that's the reason I split mine out like this. So at any rate, then you hit record, and you'll actually see that I've got a running total down here at the bottom, that it knows the $10,000 I started with. It actually is now tracking. It says, okay, this was $12,000. He's got this. But on the very same day, I've actually got to write a check to the hair and makeup person because I've now been paid for this, and I usually do this stuff on time. So I'm going to write a check, and it's going to go out to my wife because she's a hair and makeup artist. No, I'm going to make it to somebody else. I'll say I'll do it to Factor. Let's act like we do it through the agency. And it's going to be $2,000, I hope. Yeah. I can put in the address. I can put in that it was, again, for this job number, SCH161017. And then the category that I would put this in is going to be hair and makeup. And again, this thing can actually, it knows I've got these categories in here. So I just hit H for hair, and it actually puts it in. But again, if you couldn't remember that, you can go to the drop-down menu underneath all of this. So it would be hair and makeup, and I'm going to simply hit record. And again, once I print my checks out, you'll actually see that, okay, that this is indeed what has actually happened, is that I've got a $2,000 expense right here and $12,000 in income. So what I've actually made on this is going to be my 10 grand, right? Does this make sense? Are there any questions about this? So to see how this really ultimately then finally works out is we're actually going to do a report on this. Well, that's interesting. Huh. I have no idea why that just happened. Oh well. So I'm just going to do a standard income and expense report. That would be this guy right here, an income statement, and it would be year to date. Actually, I've got to bump this up because all this actions happen a month from now. So I'll do it at the end of the year. And let's say this is the only action that I've actually had. And you can see in my income report that it reflects exactly what I just said. I've got $2,000 in photo expenses. My photo fees were $10,000, is exactly what I wanted. And then I've got my total expenses here, and it's categorized. So that when your accountant or you yourself needs to look at this, you know how to split out the stuff that you spent on hair and makeup or styling, and you keep that separate from the stuff that you spent on your office, and you keep that separate from your film cost or your seamless cost or your whatever cost. Does this make sense? And it's just the simplest way in the world to actually keep your records. If you use your credit card, you simply do this when you pay your credit card statement, the exact same thing. You do the exact same thing here. Does this make sense? So I'm going to do one more example really quick just to show you how this would work again in just a slightly different fashion. So let's say that, again, I do another job, and this time, again, we'll also say I got paid on the same date. Deposit, and this time I'm going to do from Bonton. And let's say they pay me 25, oh, let's do something easier than that. Let's say again, I've got a job that is now, so it's another $10,000 in fees, but now I've got $2,000 worth of hair and makeup, but I've also got $2,000 for a stylist. Does that make sense where we're going with this one? Okay, so so the Bonton job, they're going to pay me $14,000. Again, in my drop-down menu, I'm going to split this and open it up. So in my first thing, it's going to be my photo fees. And again, it's $10,000. And again, the rest of it is expenses. Again, these are expenses as income. It's just, I'm delineating them in that way. It would be $4,000. And I'm going to go ahead and say okay to that. And then I'm going to write 2 more checks. And the first check I'm going to write, actually, it's going to be, yeah, we'll do 2 checks. Factor. And it's going to be $4,000. Not 2 checks, but 2 different things. It's not going to be that job number anymore. But instead of my hair and makeup being the whole thing, my hair and makeup now is only going to be $2,000 of it. And let's say styling. It's also $2,000 of it. And You couldn't find styling. It's right there. Oh, stylist fees. Sorry. And then the exact same thing is right here, again, balance as far as the money that I'm making, the money that I'm spending. And again, if I go and look at that very same report again, and I look at my income statement, again, through the end of the year, and you can see the exact same thing right here. My total income, and it's tracking my total income. It's got that part really good. $20,000. I had 2 jobs that were $10,000 each. That's my total income here. My total expenses, I have $4,000 in hair and makeup fees and $2,000 in styling fees. The total amount of money that I was actually paid is this $26,000. But again, I've got $26,000 have been paid. $6,000 of that was expenses. So my net taxable income down here is 20 grand, and I'll keep tracking this forever. Does that make sense? Okay, finally, I'm going to do one last thing. In this case, I'm not going to add an income at all. I'm just going to do expenses. Sorry, guys. Just to show you how this works. So again, I'm going to write one more check. And this is going to go to Visa. And I'm going to make it for $1,500. Should be that lucky. I said I should be so lucky. And let's say, okay, this is great. So we will do equipment rental, because I rented some gear and I put that on my credit card, and that was $750. And what else could I do? Oh, I had gasoline, and that was $100. And I had magazines and books. That was $50. And you'll see as you keep doing this, the figure down here just keeps getting subtracted more and more and more. It's basically telling you what's actually left. And let's say I did, I had a big repair. I had a camera repair, which was $500. And then finally, I had parking, was $100. I'm gonna go ahead and hit return. Now when I actually do my, again, my activities, reports, and the same thing. And now what you can see is you've got a total breakdown of all the expenses, and it continues to keep track of all of this stuff for you. And this is ultimately what your accountant is going to need to actually do your taxes. Does that make sense what's going on here? So again, it's the way to account for credit cards inside of your bank account. And other than this, you're good to go. This is all the accounting you'll ever need. Are there questions about this? Okie dokie. So we talked last week. Let me make sure we talked about this last week. Okay, everybody in the world has gotten a W-2 if you've worked. It looks like this. And this is where all the information about who has paid you goes into here and all this kind of stuff. This, again, is the exact same thing that I was telling you about here in terms of how this is broken down. This is the 2 things that make up FICA right here. So your total wages would be sitting up here. Then, again, your FICA goes into here. It's split between these 2. Nobody does Social Security tips then. The money that was withheld for the feds is here. The money that is withheld for the state is down here. So, and everybody gets this, and it just basically tells, you give it in, when you send in your tax return, you send this thing in with it, and it's basically what the government has actually sent, what the employer has sent to the government about you. So they've said, Katie made this much money, she owes you this much tax, you better see this on the tax return. Does that make sense? So that's a W-2. If you're working as a freelancer, you don't get one of these, because in this case, all the accounting has to be done by the company, and this is something that you will run into all the time. Companies are loath to do this. Involves accounting. This involves keeping accounts where they're sending money in to the government on your behalf. They got to keep records for that. Nobody in a freelance world wants to do this. Everybody hates that part. It's so bad that a lot of companies will refuse to do this for you if you are an individual. They will flat out say, you're not going to work for us. However, if you're incorporated, they are hiring a corporation to do this work, and none of this has to be done. They don't do this. So again, if you're an LLC or an S-Corp, they don't have to do this. They simply hire you, they pay you a check, and they report your money on what's called a 1099. But none of this gets broken out. They don't have to keep, they just look at the check that they wrote you. Does that make sense? And what that looks like is this. So if I'm hired by Shock and they're paying Engelhard Studio, this is the only thing that they fill out. They actually fill out the same, it's all the same information here, they fill this part out. But there's only one thing that they actually ever have to fill in here, and it's this guy right here, other income. And then at the very end of this, it's other income. There's no taxes that are kept out. None of this other information has to happen at all in a 1099. That is not a 1090. Yeah, it's a 1099 right here. You can see it right here. So a lot of companies, again, and Jenny can actually talk about this. What ends up happening with models is companies are actually, so a model goes to work for somebody like Shock, and the agency bills on their behalf. The agency has to keep all that W-2 information. But the company, Shock or Bonton or whoever it is, simply gets the bill from them. All they do is they keep track of the total amount of money that they were actually paid. Does that make sense? So when you guys as freelancers work, this is what you're going to get instead of a W-2. However, they need information from you to send these things out, right? Because again, this is the way a company, so I hire everybody in this room to be an assistant on my next photo job. And I'm paying all of you. I would have to give you a 1099 instead of a W-2 because I'm not going to keep track of you. You're not a full-time employee of mine. I'm not tracking that stuff. Does that make sense? The distinction I'm trying to make here? Are we good on this? There's a limit to this, though, and it's something that you guys need to know, and you should write this down because, again, there's no other way I can tell that I can get this information. So when you hire somebody to work for you, when you hire an assistant or you hire a stylist or hair and makeup artist, and they're not doing it through another agency, they're just doing it as themselves, they are a freelancer, you do not have to send them a 1099 until they have made over $600. Anything over $600, you have to send them a 1099. So if we go back to our check situation guy right here, again, I'm going to write another check, and this one's going to go to Katie. And it's going to be her $350 for 1 day of assisting. And we'll go ahead and record this. Then when I come up to do actually my reports at the end of the year, oh wait, I need to pay you more than that. Katie, you worked for 2 days. Yeah, sorry. You worked for more than that. So wait, let me go back into here. $700. Oh, actually, we'll do another one. So I also had, let's see, Chelsea. But Chelsea only actually worked 1 day for me, so she only gets $350. Sorry. Oh. So then when I go to my reports now, instead of looking at it this way, I'm actually going to look at it. This looks so different than mine, but anyway, yeah, I'm going to look at it here in category, and we'll actually do it for the entire year. Yep. Anybody who's not being billed through a company, again, so right here you'll see that Katie made $700, that Chelsea actually made $350. Chelsea would not get a 1099 from me, but Katie would. Now, let's say both of these guys worked for Factor, and it was being billed through another company. I don't have to send them anything. No, I don't send them anything. I don't fill out any tax forms at all. Again, they're a corporation. So that's another advantage. If you're incorporated, the same thing actually happens to you. I get nothing. I don't get W-2s, I don't get 1099s, I don't get anything.
But you still send them back to the check.
Oh, yeah.
Okay.
Yeah. But what I'm saying is that I would have to, if it was one of you guys, because you're, right now, you're not incorporated yet, I would have to tell the government, I paid these people this much money. But if you are incorporated, I don't do anything for you. No, I don't send them anything. So let's say I made a mistake. No.
When they're an individual person.
Yes.
You just send them a
No, I have to track this. I actually send this information to my accountant. I say, I actually paid Katie this amount of money, and she fills out a 1099. She sends one copy of it to the government and the other copy of it to Katie with all this information. This is what I paid you. Now, I'm not holding any taxes back on her, but I'm telling the government, hey, this person made this money. She owes you taxes.
So what would you send?
Katie gets a copy of a 1099. So does the government. So this 1099 right here, my name goes right in here. I paid. This is who it goes to. So this is going to be the recipients. This is going to be Katie's identity. This is going to be her recipient name. All of this stuff is going to actually go in here. And her social security number is going to be on this as well. And down in this column, wherever it is, the total compensation for this, gross proceeds, you can tell I don't ever fill these things out. My accountant does all this. Other income. This would be where I would actually list what I actually had paid.
So you pull that out then send it to her?
Yes. Yeah, I have to do all that work. This is, again, another reason that companies do not want to touch individual people. They have got to do all this accounting. If they're working with, if you guys are incorporated and they're working with another company, they don't have to keep track of any of this. They don't deal with any of it. Are we good on this, guys? Yes. Again, it's, the same thing. There's people who, usually what ends up happening is that in your all's place, you would actually call me and say, hey, I'm still waiting for my 1099. Will you send it? But if I never send it to you, then I'm actually in violation of the law and they could come after me. Oh, yeah. Yeah, the government's really serious about its taxes. Hannah.
What about the W-9?
Oh, so that's going to be the last thing we get to. But as long as we're here, are there any more questions about this, Katie? Yes.
Okay, so when we graduate.
Yes.
And we're like not making any money.
Yes,
So
and you're not incorporated yet.
Yes.
Yes.
So does this mean people aren't gonna like want to hire us for like to be assistants because they don't want to have to fill out the paperwork?
All I'm saying to you is that this complicates things.
Okay.
Again, if you're an LLC, then that doesn't complicate things. You say to them, I'm an LLC. You give them still all of your information. What ends up happening as an LLC or an S Corp is you get a number that's basically a tax ID number. It replaces your social security number.
Okay, so can we like incorporate even if we're like not making?
Oh, sure.
money? Okay.
Yeah.
That
You can
makes
do it
sense.
tomorrow.
Okay.
Yes, and it would probably be a good idea to have that ready to go before you leave.
Okay.
Yeah, yes.
So you send them that form for just one job if it's over?
No, again, so for instance, I had a first and second assistant forever. And it was the same people. They worked for me every week. What I send them is the total that I've paid for them for the whole year. So you wait and you do this. That's why you get all of these in January, is because you have to wait for the year to end. So then between the 31st of December and the 31st of January, you got to sit down with your books. Again, you can just see right now an electronic tracking checkbook like I'm using right here does all that work for me. I don't have to go through and find every check that I wrote to Katie and every check that I wrote to Chelsea and add them all up. It's tracking all of that for me, which is just, that's what you need. Otherwise, it's a nightmare.
So for each person, you only have to do it once a year?
You do one. You only do it once a year, and you do the total. So if Katie, if I was paying her $1,000 a week and she'd been there for 40 weeks, that 1099 would read $40,000. And again, the threshold of that though is $600. So I think they do that in part, Katie, to make it not as onerous on somebody if they're only going to use, let's say, oh yeah, I'm going to try you out and I'll try you for one day and I didn't really like what you did, or you weren't really where I was at, or that kind of stuff, whatever, and I never hired you again. And so I paid you that $350 and I don't have to think about it again. I don't have to send you any paperwork. It's only once you cross that $600 threshold that you have to do 1099s. Yes, and actually you keep one for yourself. This is done in triplicate. So, because one of these goes in on your corporate income tax returns. It goes in, you have to attach it to your, just like you do with your W-2, you have to attach it to your federal and state income tax return. So actually, I think you get 2 copies. Actually, you get 3. You get 3 copies. It's one for the Fed, one for the state, and one for your records.
So you don't have to send them anything under 600. So
Right.
really go around and just assist different people.
Yes.
Do like 350.
Yes.
Stay on their
You could do $599 for each one of them and end up making thousands and thousands and thousands of dollars. No, no, it's still your responsibility to claim your income. Because again, you're under that limit. All the 1099 does is and again, the case with Katie and me, right? I'm telling the government I paid this girl $600 or $700. I'm just telling them that. Then they say, okay, when she files her income tax return, I better see at least $700 on there because you've just told me that you paid her that money.
But you would still have to claim that it was like 400, so you just have to keep track of yourself.
You yourself, yes. So again, if you worked for, let's say every single week, 50 weeks out of the year, you worked for somebody and it was $599. It never got to be $600. You would not get tax information from anybody. But at the end of that year, that $30,000, $40,000 that you had made, you have to file an income tax return on that. You, as an assistant, have to been keeping track of all of that money that you were paid, and you have to declare that on your income tax form. It's for me to basically tell, again, what I'm saying is that, let's say this, let's say that you work for me and you made $40,000, and I send the government and I say, Jenny made $40,000 with me, and you send in your income tax return, and you've actually only claimed that I paid you $20,000 because you don't want to pay the extra tax. You lied. You're busted. Totally. They take all the Social Security numbers that I've put in on my 1099s, and they take your Social Security number, and it's all computer electronic. And all of a sudden, I've said I paid her 40 grand, and she's only claiming 20 grand. Red flag goes up. They look at you. If somebody who looks over your tax return thinks that there's something weird, you get audited.
So if you hire someone and pay them over $600, you have to get their Social Security.
Yes, you do. Okay. Yes. That's one of the reasons I'm not showing you my bank accounts, is because all the people that I've got their Social Security numbers sit in their accounts, and they're sitting right there because life. And it's like, not that I don't trust everybody in this room, but I record these things and then post them. I realized, I actually did this once. I have a spreadsheet that has all of my passwords, and I was going through programs to get to a different program, and I crossed right over my spreadsheet of all of my passwords and recorded it, and that shot right up to YouTube, and I realized what had happened the minute I did it, and I went and I pulled it down, but yeah, that's why. Did I ever tell you guys that I used to never let anybody record any of my lectures, because you guys know by now I have somewhat colorful language, and I really didn't want somebody going into the provost and saying, yeah, the language that's going on in that classroom. I just didn't want to do that, right? So I said nobody could ever record any of my classes, and now I, of all people, record the fuckers and put them up myself.
Those old students are probably so mad.
Yeah. Anyway, Haley.
Okay, just trying to wrap my head around the Quicken 2007 program.
Yes.
You were showing that to us just to give us an example of a program that we can use to like help us keep track of our expenses.
Exactly, and your income both.
And it's like just something that we can go back to and be like, okay, this is where that money was spent, and it's not anything that we actually send out to
No.
other people, right?
No, it's not.
Ourselves.
Yes. And as a matter of fact, the program is designed to actually write the checks for you. It's also, if you do electronic banking, it hooks right into your bank, so you can still do electronic banking. It will download all the transactions for you. So it just becomes your check register, is what it really becomes. But the advantage of it is because it is electronic, then you can search it endlessly different ways. You can say, how much did I spend? How much did you can actually do a search just for Katie. How much did I spend on her? Because maybe I paid her as an assistant, but maybe I also paid her as a hair and makeup artist. And I don't want just the cost that I paid her as an assistant. I want to know what I paid her.
So then you like look in the system, you're like, what am I paid, and it'll show you all of the different.
Or I can look up Katie just by herself, and it would show assistant, and it would give me a total. You paid her $22,000 in assisting fees, and you paid her $15,000 in hair and makeup fees, and you paid her $5,000 as a stylist. I mean, I'm just trying to show you that you don't want to only be able to sort based on these categories, assistant. You also want to be able to sort on people and other things like that.
When someone says like, oh, they're paid under the table, is that when you don't do any of that stuff?
Yes.
That is what that is. So how does that actually work? If you live in Italy, that's like 90% of their economy is all under the table. But they make it up by charging you $15 for a gallon of gasoline. That's how they get their money.
Are you serious?
Oh, it's exorbitant. But yeah, but anyway, so this is the deal about under the table. So what a lot of people will do is if they figure that so you do a job for me, and typically I would pay you $1,000 for it. Let's just say that. I could come to you and say, well, okay, Alex, you're going to have to pay 25% in taxes. That's $250. Instead, I'll pay you $800, and we don't report it. So you make an extra $50 because instead of having to pay, you lose the $200 that I'm underpaying you, right? But you pay no taxes at all because I gave it to you in cash. You know, what's the advantage to me? Well, the advantage to me is that I'm still going to bill my client for $1,000 for your work. I've only cost me $800, so I get to pocket an extra $200. You and I both win. No, I don't get that. No, all right, so the piece of advice that my accountant gave me years ago, and then I'll pass on to you guys, is that it is your duty to be as aggressive as you possibly can. It is folly to be illegal. So don't be aggressive. And what do I mean by aggressive? Well, that's when I say, yeah, my cable bill, of course that's work-related. I can't do my job without it.
So,
That's aggressive. What isn't aggressive is me saying, oh no, I didn't pay Alex anything. And actually, I've really paid you in cash all along. Yes?
So what if you live in your studio?
That's actually a good question. All right, so, because again, this is in the whole part of this lecture right now in terms of things that we call red flags. So this would be a red flag and how you figure it out. And again, yet another reason to be incorporated on some level, LLC, S Corp, whatever. So in your all's situation, so what's gonna happen now for you guys is, as an LLC, you basically get all of this money, you track all the money, you track all your expenses, and there is an additional set of pages that they put on your income tax. It's actually called a Schedule C. So right now, up until this point, if you guys haven't done any freelance work, you simply have probably a 2-page tax return. It's a simplified or a short form 1030 tax form. I don't do one anymore, so I can't remember.
I don't know, I haven't counted.
It's a what? 1044. That sounds almost right.
1099.
No, that's the thing that I sent out. You're just your typical income tax.
1040.
1040. It's a 1040, right? Yes, you're absolutely right. There's two versions of the 1040. There's the short form and the long form. The short form part is what most of you guys do. You get one W-2, you fill out your information, you write in all the figures on the W-2, whatever, you sign it at the bottom, you send it to the government either sends you money back or you send them more money if you owe them money. And that's it. When you start to run a business, though, that's under your name, you go to the long form. It gets longer, and they start adding what are called schedules. And all schedules mean are they're different forms that are attached to. They're like additional pages that are attached to. It's still 1040, but for instance, if you get into real estate, I think that's a Schedule E. And if you do, but anyway, the business part of it all is under a Schedule C. So you would fill out this whole Schedule C that gets attached to your 1040, and then that's how you would actually report your income to the government. And on your Schedule C, you can do all the same things. You can do, hair and makeup expenses and all that kind of stuff. However, the problem with all of this is that it goes in on your personal return, and that's true of an LLC as well. In an S Corp, this all gets filed under a corporate return. So the first thing that the government looks for on a personal income tax return, number one thing is home office. Because the criteria for home office, or for any office for that matter, the criteria is that it has to be used 100% exclusively for business. So what does that mean? You've got a bedroom that you use as an office, a second bedroom, right? But do you let anybody sleep there, ever? Well, if you do, then that's not 100% exclusive for business. That's personal space as well as business. It would not qualify for a home office. Make sense?
Yeah.
So in my studio situation, this is the studio that I used to have.
How would they know that though? If someone getting stuff there.
The first one, again, and no, it really comes down to this. I know people who have actually been audited for that and moved all their furniture out so that it looked just like an office. There was a bed in there. They jammed the bed in the living room. There was chest of drawers in there. They jammed that shit in the bathroom. They strip it all out so that when the government comes to look at your home office, no, it's true. I'm sorry? Yeah? So anyway, this is what I did when I had my very, not my first studio, but the first studio, it was an old department store, and they had subdivided the floors. The floors were 6,000 square feet each, and they'd subdivided them, and so I had a 3,000 square foot studio. And when we designed the studio and laid it out, this was the front door was right here, and there was a bathroom right here. And so what we did, and there was a kitchen right here. So what we did was we put the bedroom in here. So this was the bedroom right here, and this was a living room right here. And so what I did was I actually took a line and where the so the living room ended right here, right? I took a line from the bathroom right here and I drew it right down here. And this part right here was personal. But this part right here was professional. And it ended up being, when I did this, that the personal was 30% of the space, and just by square foot. So there was the personal part was 1,000 square feet, and the professional part, the shooting part, was 2,000 square feet. So the professional PRO was 70%, and then everything gets split up that way. And this is actually another great way for your all's accounting to think about doing it this way. When I would write a check to my landlord, let's say I would write two checks. The corporation would write one check for 70% of the rent, and I would write a personal check for the other 30% of the rent. It kept them completely divorced from one another. Nobody had to do any figuring later on. When I wrote a check to ComEd, it was exactly the same thing. When I wrote a check to People's Gas, it was exactly the same thing. Two checks for everybody. So there was a personal check and there was a corporate check. So that if I did get audited, it was really simple for me to whip out all of those bank statements from personal and professional and say, okay, and I had a blueprint of the space that was divided and exactly how I calculated the split. And so I kept those two separate, and I actually not going to let it happen audited, but does that make sense how to do this?
Yeah, what about like for your phone? Say if your business phone is your
No, it's exactly the same thing. However, what's interesting about that, or you would say about that, is we actually right now do our phone 100% of our business.
yeah, because mine's like that too.
Yeah, I don't worry about getting clicked on an audit for a phone. That's not something that's really going to be causing me a lot of problems. But I'm just telling you, the red flags. So what red flags that you guys need to worry about? Well, let me just finish telling you this part. So this is how the whole thing happens. But imagine the office, what some people would consider to be a home office here, a very large one, right? It's still studio space. I'm declaring that on a corporate tax return. The corporate tax return is, they're expecting an office expense on a corporate tax return. They do not expect one on a personal return. They think people who are using them on a personal return are actually trying to, again, it's the #1 red flag that there is for an audit, is claiming a home office. However, if you do it on your corporate return, they expect that. So that all goes away. There's no home office deduction that shows up on my personal income tax return. It's all been handled in the corporate return.
So if you bring all those T's in,
You don't have that advantage. All comes through on you. It's going to be on your Schedule C. It is a personal return.
so it's gonna be a red flag.
Again, so then you have to ask yourself, how aggressive do you want to be about this, and what can you really say? So again, in most people's cases, let's say you have, you're spending $1,000 in rent, and you dedicated that 1 bedroom to just be your home office, right? Well, that home office, you figure out that that home office is 15% of your space, right? So conceivably, you could write off $150 a month, and you're in a 25% tax bracket. Again, your part of that expense is what you get to write off, right? So it's $150 a month, but you only get to write a quarter of that off. So that's $75 a month is what you get to write off. Is that worth the possible audit? What you could possibly save? Because if you multiply that times all 12 months, you get 150 at 2 times 6 is about $1,000 is what you get taken off. So maybe that is worth it. And again, if you can prove that, so I'm not trying to say, again, I just told you guys you should be aggressive about this stuff, but I'm just telling you what they're going to expect. So if you're prepared to have them come out and look at your space, again, they don't do it. They're not going to come out and surprise you. They're not going to Elliot miss you. I'm sorry, what?
Don't forget to tell
Yeah, they set up an appointment. They say, you know, you've been audited. We need to come, blah, 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 blah. And you'll say, okay, fine. And it gives you plenty of time to rearrange your furniture if that's the way you want to go about doing it. But so anyway, #1 flag, home office. #2 flag, wardrobe. And I'm not talking about wardrobe for photo shoots. I'm talking about your own wardrobe. You can't deduct that stuff. A lot of people try to do that stuff. They try to get away with it. It's my wife's largest expense, to be perfectly honest with you. If she could deduct that, it would be great. But that's the 2nd flag. And the 3rd flag is your car. So how do you do your car? A lot of people will say this, that in doing your car, you should keep meticulous log records of every mile you drove, what your mileage on your odometer was when you started, what it was when you finished, for every single trip that you did that is related to your business. I find that to be a colossal pain in the ass, so I don't do that. What I do instead is this. I pay everything, so when you talk about what your car is, if you've got a car payment, your gas, your parking. Oh, let's actually not do parking. I'm going to leave parking out there because parking is legitimate. You can get all of that. But the cost of running your car, gas, insurance, repairs. And so you add all of these figures up. So whatever these all end up being, you total all of them up, and let's say on a given year it ends up being $2,000. Then what I do, and what will be considered pretty much a norm, is I do 80% of my total car expenses I deduct. I then pay the other 20% out of my personal. A lot of people will argue that if the government sees this, that they will look at it and say, okay, they're not trying to gouge us. So somewhere in that 75 to 80% range is a good place to be. I would argue that 80% is a good place to be. If you come in with 95% as a business percentage and only 5% is personal, the government gets angry with you. So 80% of this is a safe figure. 80% of the cost to operate your car is pretty much safe as a business deduction. So that's what I do. I total up the cost of the entire year for these items. 80% of it gets paid by the corporation and 20% of it gets paid by me. Yes?
What if the company pays you? Like it's on your invoice or parking?
Exactly. Okay, so again, and this is the same thing. So let's say, for instance, this would be a perfect example. So let's say that you do a job for me, and I'm going to pay you $500. Just keep it simple, right? So it's an assistant fee, and it's $500. and you charge me for gas as well, and you charge me $50 for gas, right? So gas is 50. So I give you a check for $550, and you have to claim $550 in income, right? So your income is $550. Sorry. But you're keeping track. You have to pay the gas. You had to pay gas. You had to pay for the gas. You bought the gas, right? So your expense, you had a $50 expense. So your net income is $500. So they wash each other out. For me, it's the same. For me, this is my expense to you. I'm paying you the $550. So the people who ultimately get taxed on this is the gasoline company. You paid them the $50. They're the ones that made the income on the gas, right? It was an expense for you, but it was an equal amount of income for you. So the two wash each other out. They cancel each other out, right? It's an expense for me, but then it's an income for the gas company. So the government still gets their cut. Make sense?
Yeah.
Okay. Are there questions about this? Okay, so somebody asked before about about a W-9. That's the last form I'm going to show you right now. And you'll do this for anybody that you go to work for. This is how you give whoever you're working for your tax ID information. So you'll see here, if it's a person, if it's just you, and you can download, I know assistants that keep copies of these. They just keep copies in their their backpack or their whatever, and they just carry them. If they go to a job, they bring one of these, a blank one of these, and then you can just fill them out by hand. This is how you report your tax ID information to the people who are going to pay you. And so basically what goes down here, if this would be your personal, if you're doing this as a person, this would be your corporate if you're doing it as a corporate. This is your address information all down here. And these are the two different things. If yours, if you're doing this as a sole proprietorship or just as a person, it's just you. You give them the social security number. If you're doing this as an LLC or an S corporation, you give them this employer identification number. So this is sort of like the social security number for the corporation or the LLC. Does that make sense? So this is how this is, again, if you were going to come, if Chelsea was going to come be an assistant for me, she would fill one of these out for me. If, again, I was going to pay her more than $600 for the year, I've got to send her a 1099, and this is where I get the information of where to send it. And you can see up here, they'll say, what are you actually going to be? Are you an individual sole proprietor or a single member LLC? Are you, again, a C corporation, an S corporation, a partnership, blah, 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 blah. It's sort of like you're telling them what you are. Yes?
I thought you didn't have to use the whole fill up the form that you're a C corporation, S corporation.
This is just a request for a taxpayer identification number. This has got nothing to do with what they send you or don't.
So why would you need to fill this out if you don't need to send it? If they don't need to send it?
Don't ask me, I'm just telling you, this is just the official way that you are giving that information if you're asked for it. Yeah.
So if you work for a company, you didn't fill out, can you just send the company that? And then,
Wait, try that again?
so you work for a company, you didn't fill the news out,
Right.
and then just send them one?
No, the onus is on the company to get that information from you.
So I would get in trouble.
It's not your job to give them your information. If they ask you for it, it is. It's your responsibility. But that's not your job to do that. That's their accounting company. Their accounting part should be contacting you and saying, we need to get your social security number because we need to send you a 1099.
If they don't.
That's their problem. No, that's their problem. But where you could run into an issue with this is that if you say, okay, they never asked for my tax information. They never sent me a 1099. The government doesn't know I've done this work, so I'm not going to declare it on my tax return. That is illegal. If you get caught doing that, you can get into trouble. So if they never ask for it and they never send it, but you actually are all above board and say, okay, they paid me this money, I am going to declare this on my tax return and pay the tax on it, then you've done nothing wrong. Whatever they want to do with the company is whatever they want to do with the company. By the law, the company's obliged to actually send you that information if you make over $600. But if they don't do it, it's not like you're going to get in trouble for that. But you've got to declare the income on your own return. Or gamble. What can I tell? Okay. Then I know I've told this to somebody. Did I ever tell you that there was a girl that, when we were living in Italy, we would come back occasionally to do jobs, and they were really good friends, and we'd stay at their house. She was a model, and she was a really successful model. And she didn't file an income tax return for 5 years. She was making over $100,000 a year in this whole time. So she didn't do this, she just didn't, but she knew that she owed the government money. So every now and then she would just write a check to the government. Literally, she would write a check, US Treasury, she would put her social security number on it and just mail it. No return, no nothing, no letter, no hi, this is me, whatever, she would just mail it. And so she's not filing these returns, but she's sending them these checks with her social security number on it, and her name and address and a bank account and all of that information, but no return. So eventually she got audited, and as it turned out, she had actually gotten extremely close to paying them what she owed them. But she would send them every now and then, she'd just send them a $10,000 check. And it turns out after 5 years, she actually was relatively close to what she owed them. But they were so upset with her for not filing their returns, they spanked her really hard for that, much harder than for not paying the money. It was for not filing their returns. So, anyway. Yeah. Okay, there are questions about this. I know, scintillating, isn't it? You remember our very first day here, guys, when you all said, okay, we really want to learn the ins and outs of business. We're really motivated and all that. Just keep that in mind, right? Well, I don't think I've lost anybody yet. Okay, we're going to touch on just a couple other things really quick, and then we'll take a break and get into doing something a little bit deeper. I just want to talk about a couple of issues right here. So when you guys actually do graduate from here and you go out on your own, gear becomes a huge issue, right? How much gear do you really buy? How much gear can you afford? When do you buy it? So here's the trick and the thing that you need to keep in mind. Most of you, when you go out on your own, the income is going to start relatively slowly, and the gear expense can be enormous right off the bat. So if you don't have a whole lot of money, or parents with deep pockets, or a good friend, or a sugar, whatever, you don't have some source of income other than your own, you, on your own, one of your options is to actually buy it with credit cards. That would be the single most expensive way you can do it and the stupidest way to do it. I'll just tell you that right now. A better alternative, if you're hell-bent and determined that you have to have this gear, my first question to you would be, do you really need it? My second would be, can you rent it? Because again, even though renting it, you don't get to own it, at least you can pass usually the rental cost on to whoever you're doing the job for, so you don't take the hit. If you feel like you have to have it though, and you're going to buy it, again, credit card, the most expensive way to do it, there is the Small Business Administration. They call it the SBA. You can find it online. Their design, their job in this world is to actually write affordable small loans for small businesses. Now those loans are usually limited to, the cap on that is usually $25,000. I think that's still the cap on it, so you can't get more than that. However, you can't also just go to them and say, hi, I've decided to be a photographer, will you give me 25 grand? They're going to expect more from you than that. They're going to they'll probably expect to see that you actually have been in business for some period of time. I don't know what all the criteria is. You can find it though. Again, go online, look under SBA. It is by far the better way to do it. So instead of having a 25% loan, a loan at a 25% rate, you can actually get a loan at 6 or 7%, something closer to that. So if you feel like you've got to do it, that's a much better way to actually do it. However, there's another consideration in this, and it's this. If you are making a lot of money and you incur this kind of expense, then you can deduct that expense from your income and lower your tax bill. Great thing, right? But if you're not making any money, you're not paying any taxes. So there's nothing to take this expense off of. So you're not getting any tax incentive to buy this gear. The government's not paying for any of it because you're not paying any taxes. So the worst time to be buying gear is when you're not making any money. The best time to be buying it is when you're making a whole lot of money. Does that make sense? So it's just in your timing something to think about. If you can avoid buying anything that you feel like you have to have until you've actually started to make some money, to get the government then to kick in its part of that expense. Does that make sense? So, and that goes true for everything that you're thinking about doing. You don't want to actually start with a full-blown studio come June 1st when you graduated from Columbia in May, because you're not making any money then. So even though you've got an expense that's a legitimate, deductible expense, if you don't have an income that you can remove that from, you are not going to see any tax savings at all because you're not paying any taxes. Make sense? Okay, there's another thing, as long as we're talking about this, we should throw in here, and it's a thing called depreciation. It happens more with automobiles now than it actually does with gear. It used to be that when you would go out and let's say I went out right now and I bought $25,000 worth of gear. It used to be, and when I mean used to be, I'm going to say back in the 80s, they wouldn't let you take the full $25,000 off in one chunk. What they would do is they would say, okay, you can take $10,000 off this first year, you can do another $10,000 next year, and then do the final, in the third year, you can do the final $3,000. That's called depreciation. So instead of it just being a flat out expense that you take the money off, whatever, and you're good to go, they carry it out over a period of time. Again, it allows the government to keep more of your money. However, every year since then, they've actually started adding on to what that amount is. And now the amount that you can actually buy, that you're allowed, the first year of your depreciation is well over $100,000. It may actually be $250,000 now. I don't know what it is. It's well more than what you guys are probably going to get into buying as far as gear goes. So it's not something you really need to worry about. However, they still insist that you do this for cars. So if you go out and buy a car for your business and it costs you $40,000, you do not get a $40,000 write-off year one. You get like a $7,000 a year write-off in year one, and a $7,000 a year write-off in year two, and they drag it all out. So just so that you're aware of that. Are there questions about this? So really think about planning that out. How many people in this room have health insurance? I really shouldn't be able to ask you that, but so sorry. So, oh, sure, of course it does. Okay, no, that's a beautiful thing, right? So I'm just going to go out here on a limb and tell you this right now. Nobody in the world likes to pay for insurance. Everybody hates it until you need it. And then when you need it, everybody's thrilled that they actually have it. And it doesn't work just for health. There's other insurances that you need to take into consideration. And the two that really pertain to your business the most are liability and equipment. Those two things are the things that you care about. So again, even though you are incorporated and you are protected against somebody forcing you into personal bankruptcy, if somebody is hurt in your studio, you need insurance to cover their injury. It's the same thing with auto insurance. And again, part of your auto insurance is to take care. If somebody's really hurt in a car accident and you're at fault, then your insurance hopefully is good enough that you don't have to pay anything out of your pocket for their medical bills or for their rehab or any of that kind of stuff. The insurance company takes care of all of that. Well, that's great for your car, but how does that apply to you and your business? So in that sense, it comes under business insurance. Now, I will tell you right now, actually I'll show you this guy's information. The #1 photography insurance person in the United States is a guy out of California. And this is him and his information. Can you guys see that? Yeah, this is him. He's in LA. It's Tom C. Pickard. It's a huge company. This is their number right here. Or no, that's their fax number. This is their number right here. This is actually their address right here. You can find them online. This is the number. These people deal with photography insurance, again, more than anybody else. They're insurance brokers. So, for instance, I get my insurance via them. They handle putting it all together. But the actual insurance company that my insurance is with is Fireman's Fund. But they're the people that actually puts this together. And what happens is you simply call them up and you say, this is who I am, I'm interested in protecting. Usually the two things that they care about the most are the amount of gear that you have that you're trying to insure. Because this gear thing has to do with how much gear do you want to insure so that if it's stolen or if you have a fire and you lose it all, whatever, how much do you need to replace the stuff that you need to actually go ahead and do business? Now, the first mistake that you can make is to insure everything you own. Don't do that, because the more you insure with them, the higher your rate is. That's what they use to really establish your rate, is how much gear you're really doing. There's other things that are involved, but that's like the big one. So what you really want to ensure is, what do you really need to get back into business tomorrow? So you're going to probably need a computer, a camera body, and a lens at the very least. So those things are going to be on your list. I've got 15 power packs and 30 heads. I insure 4 packs and 4 heads. I don't insure the whole thing, it would just cost me way too much money. Can I do a job with 4 packs and 4 heads? Probably, or at least I can get started. So does that make sense? So it's the thing to keep in mind. But the advantage of doing this with them is this. When you get that, you actually get something else. And this becomes, again, I don't know how they deal with this as far as doing it in a sole proprietorship. I don't think it really changes that much. I don't think it's that different whether you're whatever you are, an LLC or whatever else. But this is the other thing that you want out of them, and you can only get from them. This is called a certificate of insurance, and basically what it is, it's proof of insurance. And you can see this is actually mine right now. This is a real one for me. This was done back in 2011. Not very much has actually changed. But this is the thing that matters, happens in the certificate of insurance. You want to go shoot in Grant Park, and you approach the Parks Department and you say, I want to do a photo shoot there. They will insist that you have a certificate of insurance. And what that means is that you are saying to them, I'm proving to you that I have insurance, that if somebody is hurt in us doing this photo shoot in the park, that we are going to indemnify you. You are not going to be, the Parks Department is not going to be liable. That my insurance will cover any suit that would be brought against the Parks Department. Does that make sense? So the Parks Department doesn't have to worry about it. That's basically what it all boils down to. The Parks Department says, oh, okay, Engelhart Studio, they've got insurance. They are sending us this. As a matter of fact, this actually may be for the Parks Department. Let me show you the bottom of this, or better yet. To do what? Most people know, because that's really a deal between a landlord and you to actually do that stuff, so that doesn't really function any different. What this really becomes an issue is, and let me see, this was actually for Calumet Photo. If you're going to rent gear, you have to have a certificate of insurance, because again, this is to say, okay, I rented $75,000 worth of gear from you and it was all stolen. Is that going to fall on Calumet's insurance or mine? So again, this is me specifically saying to them that I have got insurance that will cover the rental gear. So every rental house that you try to get stuff from, you're going to need a certificate of insurance. Every public place that you go to, I want to shoot in the auditorium theater, you cannot do without a certificate of insurance. I want to shoot on the L tracks, I want to shoot on the train station, cannot do without a certificate of insurance. I want to shoot in the plaza that's in front of, I want to shoot in Daly Plaza. Won't be able to touch it without a certificate of insurance. So without having a business insurance policy, you cannot get a certificate of insurance. That's what this is. This is your business insurance. So you'll see, I'm going to zoom back into this area again here really quick so that you can actually see this. You'll see here what it actually covers, and you can see right here, for each occurrence, I have a $2 million policy, $2 million of general commercial liability. Then there's other things in here. If you've actually rented something like a place, you rented, this is actually to cover, let's say we rented some house in Lincoln Park, whatever, and I was really into fire that day. We were shooting barbecue pictures and I burned their lawn to the ground, right? This would actually cover the burning of their lawn to the ground, whatever, whereas if I burned their whole house down, that would actually come under each occurrence here. There's medical coverage that's in here. There's personal injury that's in here. Then there's what they call general aggregate. It's putting all of this together. So basically, I've got $4 million worth of insurance. All of this stuff is pretty much boilerplate. I also carry hired auto on this and non-rental auto on all of this. So when I go to Hertz and they say, do you want our exorbitant insurance? I go, no. And they say, well, you need proof of insurance. And I've got this. And this actually, unlike renting a car and a credit card, this actually will pay for a damaged automobile card. But again, you can't get, this is something that I'm getting with my policy that's also covering my gear. It's all the same policy. It's a benefit of getting your camera coverage and all of that kind of stuff. Does that make sense? It'll also cover accidents in the studio. I had a fire in the studio. This is the policy that actually paid for the fire in the studio.
You have to do, like as you were saying, you'll rent a house and or whatever. So
Right.
every time you go to like say use like a location
Right.
or rent gear, you have to go to them and be like, hey, can you add this to it?
Yeah, it's exactly what you do. And it's really funny. To this day, they still prefer faxes, but they do take emails. But you email them and you say, I need a certificate of insurance for Calumet Photo for this period of time. And they usually charge you $75 processing fee to do it. And then that's it. And then they're just on the policy.
So you have a specific policy, say for like a year, but then they'll charge you 75 every time you need to add something to it, or like
Exactly.
like reference of this is what I'm doing.
Exactly. But it is conceivable that, let's say I rent from Calumet 10 times a year. It's conceivable that I could get one certificate to cover the entire year, right? So that I'm not having to do it every single time. But again, any location that I've got, I'm telling you this right now, nobody in the professional industry will touch you, will let you come into their place to photograph without a certificate of insurance. They just won't let you, they will not do it.
So basically, it's
You've got to have this if you expect to do that kind of work. If you're only going to work in your studio, you don't need this. In the city of Chicago, you can actually shoot on the street with no permitting at all. You cannot shoot in the park without a permit. So there's restrictions about where you can and cannot do this. In Miami, you have to have a permit no matter where you shoot. The beach, the street, it does not matter. You need a permit. No, if you pick up a camera, you damn near need one to be a tourist there. It's the same thing in LA. You have to have a permit for everything. So, and they're going to require this. The cities all require this every single time. So what I'm trying to say to you again, this maybe isn't something you want to take on right away. My insurance, so I insure about $35,000 worth of gear. My insurance policy runs me about $1,100, $1,200 for the entire year. So it's a doable thing. It's not, again, nobody likes insurance, but at least it's not as bad as health insurance, where it's like, oh yeah, $15,000 a year. Okay. Does that cover my wife? No. Yeah.
So what if you shoot here and then want to know?
Certificate of insurance for both places. Because again, they're specific. It's got to be, the certificate is targeted for exactly who you're doing this for.
Is it for the same people?
Oh yeah. Your insurance policy will cover you anywhere in the world. That's not the issue. What you're really just doing is you're just adding these people's name to your policy. Is what you're really doing.
So if you go to a park, do you have to get that specific?
Yes.
You have to have to add
It
that.
goes out to the Chicago's Parks Department.
Also, you have to have like a separate permit.
Oh, you do, yeah, because then the city, the Parks Department actually charges you a permitting fee to be in the park to shoot. Yeah.
Like per day, like in the exact time, whatever. They can do it before.
There can be a little flexibility into it. People tend to be really anal about it. In New York, you pretty much have to tell them the exact block on the side of the street that you're going to be on and the time of day that you're going to do it. You have to be really specific. However, you can get bigger blanketed versions of it. A lot of people will over permit stuff, but they charge you for it. So, it just sort of is what it is. The biggest problem we run into is still photographers, the film industry. Because they do this in such a scale and they pay for it in such a scale. You go to rent a space in the park, I'm trying, the last time I was in the park, we rented it for 4 hours, it was $350. But a film company decides they want to shoot in the park and they're going to do it for, 16 hours of the day and, $20,000 here. That's our craft budget. It's true. So, and so it's blown it completely out for still photographers. We don't have film budgets.
So what like insurance companies? I know that there's some benefits with Hartford, so maybe it's better than better.
Again, I do my stuff all through Tom Pickard. And again, it started out, I used to have a policy with Hartford with them.
Yeah, okay, that's
They
fine.
shop it around, and they've actually, I'm on Fireman's Fund right now, but they may place me with somebody else next year. I mean, they're constantly, their job as a broker, they don't write, all they're doing is trying to find the policy for me. And then they take the cut they take the cut from the insurance company, not from me. So that's all they do. So they're constantly shopping around, looking at these policies, trying to figure out who's got the best. I just, on my policy this year, they sent me a notice saying that they were adding an exclusion to my policy to cover unmanned aircraft.
Like,
It's basically because of the explosion of drones now. So if I'm flying a drone and I crash it through somebody's window, my policy is not going to cover that. Apparently they've had a whole rash of,
you have to get insurance in the city of Chicago to fly a drone legally.
well, there you go. So at any rate, that's what they do. So again, Fireman's has got one, Hartford's got one. I'm sure that there's a lot of people, anybody will take your money. But yeah.
And so with the whole like renting equipment, so you need this.
Yes.
around the equipment.
If you don't know, no, that's not true. That's not true. If you don't have this, you have to put down the value of the equipment. You have to give them the value of the equipment. So if you rent $75,000 worth of gear, you have to give them $75,000 before you take the gear out, if you don't have one of these. Because that way, if you lose the gear, it's stolen or it burns up or whatever, they're paid for it, they don't need to worry about it.
Can you get an insurance policy, like say if you're like starting out with work or not working?
Just for like a week or so.
No, I mean like just to like be like renting gear, like say coming out of school and like you're just like assisting whatever.
You know, that would really be a question for them. I wouldn't hesitate to call them and ask them that and see if they do anything like that. Because again, it's in their interest to constantly be looking for new clients. And if you're approaching them and saying, hey, I want sort of maybe just an insurance, but I need it kind of thing as you go sort of thing, well, can we work that out? The certificate of insurance thing becomes really hard to do that though, because again, they're giving me $4 million worth of coverage here, and I don't know if they're really going to be into me asking for that for only 5 days or 2 weeks or something. But I'm not an insurance broker, so I'm not the guy to ask. I would make a phone call to them and say, I'm a photo student. There's a teacher that I have who's been with you guys for 30 years now, who's still with them, and he said to talk to you guys. And I need insurance, but I also don't have unlimited funds. What can we talk about?
Yeah, so it makes it really hard to run equipment if you like need this, where you have to get them all the money.
Oh yeah. Well, they will take a credit card for that, but then they actually put the charge against your credit card, and it happens right then. So and then they'll refund it back. But yeah, if your credit card is denied for that amount of money, then they don't give you the gear.
So you can get this without, you can rent some without this, but you have to have like your credit card.
Yeah, and they will charge your credit card right then. So if it pushes you over your limit and the credit card is denied, you can't take the gear. So you actually incurred the charge, and then when you bring the gear back, they refund it. It's not like they're just holding your credit card number in case.
Yeah.
They actually bill you for it the second you take the gear out. Okay. Anything else on this? So at any rate, it's definitely something worth looking into. It's something you guys are ultimately going to need. I'm going to talk about one last thing here really quick, and then we'll take a break, and we'll come back and really talk about how to set your rate. How did you guys do with the cost of doing business calculator? It can be confusing, at least when you first start out. I'll take a look again. You guys should have turned that stuff in tonight. I'll take a look and we'll talk about that a little bit more in depth next week. Because a lot of times what you'll see is people end up, this is what it's always happened in the past. 2 or 3 of you are really going to have lowballed it, and you'll be in the $25,000, $30,000 range. 2 or 3 of you are really going to highball it, and you'll be in the $150,000 range. And then the whole rest of you guys is sort of in that $40,000, $50,000, $60,000 sort of range. Now, I could be completely wrong. I don't know what all of your expenses are, but I'm just sort of giving you some sort of like rough kind of idea about sort of where things kind of land at any rate. So the last thing I want to talk to you about, and right before the break, is considering getting an agent or representation, again, when you first get out. So there are advantages to doing that, there are disadvantages to doing that, but the biggest challenge that you're going to face in trying to get an agent going out of this game is that agents, for the most part, they're looking for established talent that will actually bring them income immediately. And the typical way an agent works, or agent or agency, either one works, is that they will take 25 to 30% of your creative fee. So if you're billing at $3,000 a day, they'll take up to $1,000 of that. Now that doesn't come out of your expenses. So let's say you're doing the example that we were using before, that you were doing your let's say your $10,000 job. So your creative fee is $10,000. And then let's say you've got hair and makeup at $2,000 and stylist at $2,000, and then model fees at also $2,000. So the total that you're going to bill your client is $16,000. Your agency will take 30% of this creative fee only. The rest of this stuff is basically a wash to you. You're not making that money. You're collecting it, but you're turning right around and paying it right back out. So you don't make any money on that. However, there's an exception to this. I'm going to change this here really quick. So let's say that you are very clever and you're actually going to do a 25% markup on all your expenses. So you've got, I'm going to do your real cost over here. So let's say your cost for hair and makeup is $2,000. However, you mark that up by 25%. That would be $500, and that's what you bill to the client. So you bill the client $2,500. And you do the same thing for everybody else. The stylist was $2,000 as well, but you bill $2,500 for them. And then finally, the model fee was also $2,000, and you actually bill $2,500 for that. Now, in this case, what you're going to ultimately bill your client is $17,500. However, what it's actually costing you is $16,000. So in your case, you get to pocket the difference. You get to pocket the extra $1,500 that you billed on top of what it cost you. Does that make sense? However, your agency doesn't touch this. Your agency does not get part of this additional $1,500. They only get the cut of your creative fee. Make sense? Say what? Oh, but it's understood when you go in. It's understood that the cost of the agency fee is strictly your creative fee. There's a percentage of that. Any markup that you get is yours. That's excluded. Yes?
How common are markups?
How common are markups? They should be really common. I mark up everything I can. How much do you mark up, though? That's actually a better question. How much do you guys mark up? Would you mark up? What's fair? You think? There was a photographer here in Chicago years ago who actually he did brilliant work. He had a client who absolutely loved him. He lived in LA. They flew this guy in every other week. It was ridiculous. And all of a sudden one day they realized that his markup on film and processing was 100% and they never used him again. And the irony of all of that was that they loved the work and they were happy with the money that they were paying. But when they felt like that he was gouging them, that ended it. So at what point does it become legitimate markup? And where's that line from legitimate markup to you're gouging me? And the typical rule of thumb is this: 17% is a reasonable cost of a markup, that there is no client in the world that should be able to look at you and say, if they see that you've got a 17% markup, they should not be able to look at you and say that's grossly unfair. Because everybody else in the world is marking their stuff up too. If you go to have a piece printed by some printing company, you go to have a promo piece printed, do you think you're paying them what they're paying for ink and paper? No, of course not. They're marking that up. That's how business happens. You look pained by that, Hannah.
I mean, you're the one that finds the like hair and makeup artist, right? So shouldn't we get that?
Not necessarily, but you're not necessarily the one that's doing this. What really happens in this is who's really carrying the cost. So this, I wasn't going to actually get into this, but this will be a better note to end on right before break. So do you carry the cost or not? So when you're first starting out, so what I mean by do you carry the cost is that you go into a situation like this and you say to yourself, well, I could make an extra $1,500 here if I actually let the hair and makeup bill me and let the model bill me and let the stylist bill me, right? But then you have to collect that money and you have to pay them, right? And so that gets into that whole cash flow situation. Hopefully you don't have to pay them before you've collected the money, but sometimes you do. And so you're basically carrying it. You should be compensated for the fact that you are going to the bother of carrying this money. Does that make sense when I talk about carrying money, what we're really talking about here? You're responsible for this, right? Unlike, so that was somebody who's carrying it. Unlike the person who says, nope, I'm not touching this at all. All I want is my creative fee. I'm going to let the client take care of all of this money. I'm not going to do this at all. So I'm going to bill the client, but hair and makeup is also going to bill the client. The stylist is also going to bill the client, and the model is also going to bill the client. So the photographer, the only thing they're billing for is their creative fee. So they're not carrying any money at all. But they're also not making this extra $1,500.
So then you would mark up.
There's nothing to mark up. It's just your fee. That's the only thing that you've got. So there's nothing to mark up. So when is it worth it for you to do that? So there's another photographer here in Chicago who used to work for Montgomery Ward's. Montgomery Ward's was like Sears. It was a huge catalog house here. They had so much work here, it was just insane. I mean, they supported an entire industry here. So this photographer worked for them, and he was really into carrying all the expenses. He'd been very successful. He had a lot of money. He had good cash flow. He didn't have to worry about that. So he carried every expense, and I mean every expense. They spent the entire fall shooting in Miami. So he's got a full-blown crew in Miami. He's got 2-3 models a day, every single day, and they stay down there for the entire 3 months. So his billings are $1.5 million, and that's what he's carrying. But he's marking it all up, which is great. 10% of $1.5 million is $150,000, and that's in addition to his fee. Great, right? So he gets a check from them right around Christmas time, paying this thing off, right? And he says to himself, well, okay, and this is another thing about cash accounting. If you're doing this in accrual accounting, this doesn't work for you, but if you're doing it in cash accounting, it does work for you, but it only works for you really once, and you have to keep doing it forever. Because you make the money when you deposit the check, he said to himself, I'm just going to wait until January 1st so that I don't have to pay the taxes this year. I'll have to pay them next year, but I have a whole year to play with $1,500,000 worth of tax money. And that sounded great, right? So he does. He sits on this check for, he actually got it in early December, now that I remember this story. He got it in early December, and he said, I'm just going to sit on this thing for 3 weeks to divert that. He's going to have to pay the taxes on it eventually, but he's pushing it into the following year. That's all he's doing, right? On December 31st, Montgomery Ward's declared bankruptcy. He ate the entire thing. He ate 3 months worth of shooting in Miami. So there's a price on carrying this stuff. There can be a price on carrying this stuff. People go bankrupt all the time. You play with fire, you get burned. Are there questions about that? It actually gets worse, and you guys should know about this because this actually happened to me. So I was doing a job for Jacobson's, and this goes to this is actually be a great segue into what we're doing later on in the story. It will only take 2 minutes, I swear. I was doing a job for Jacobson's, and we had caught wind of the fact that they were having financial difficulties. So we started running there's all sorts of ways that you can check on the health of companies. The first one is it's actually called a D&B. You can actually run D&Bs. It stands for Dun & Bradstreet. You go to Dun & Bradstreet's website, you type in the name of the company, and they will kick out what the latest on their credit rating is, where they're at, what's going on with them. Yahoo Financial Pages also used to be a great place to do the same thing. And then finally, the Better Business Bureau is the third place to actually look at it. So those 3 places, you actually look. If you've got a client that you're not really sure about, if you've never heard of them, you should definitely be running credit checks on them. But a bigger company like a Lord & Taylor or Carson Perry Scott or that kind of stuff, whatever, you can, again, so Jacobson's was a pretty good sized company, so I ran this credit check on them, and I knew that they were doing badly, so we had said to them, we will not do a shooting for you unless you can put all the money in front, everything, 100% of it up front. We want to be fully paid for it before we do the shooting, and they agreed to it. So it comes to the day of the shooting, we don't have a check yet, so we hold the film. If we don't get the film, you're not getting paid. I mean, if we don't get paid, you're not getting the film. That would be a better order, right? And so they panicked, and they got us the money. We deposited the check, everything was fine. We gave the film, everything was fine. They declared bankruptcy literally the week after that. If we had not insisted on having the money up front, we would have eaten the entire shooting, because the shooting happened. We would have eaten the whole thing, right? However, there's this thing in bankruptcy called clawbacks. And what that means is that we would not have been considered on their list of people that they owed money to. We would not have been really high up on that list. We would have been the people who had just recently done the job. It wasn't worth a whole lot of money. There were other creditors that were basically should have been paid before us. So even after they declared bankruptcy, they could have come back to us and forced us to give them that money back so that they could have given it to the people who were essentially in line before us. That sucks, doesn't it? So again, knowing the financial health of whoever it is you're working for is pretty critical. Okay, there are questions about this? Let's do a quick break, guys, and we'll come back and try to get into something that has a little less theory and a little more practicality.
Me too.
I was so distracted.
Oh, yeah.
I thought that.
Put your name on there too.
I don't know why I thought that. 6:30. That's my other class on Wednesday starts at 6:30.
Really? There's classes that start at 6:30? I have one.
So that confused me, and I was just around the corner editing video too.
You're all right. You're all right. You're all right. Not the end of the world.